By 2011, Groupon had become one of the fastest-growing internet companies in the world, while millions of consumers subscribed to its daily deals platform, searching for massive discounts on restaurants, spas, travel packages, retail products, and local services. The company's core idea initially looked extremely simple. Businesses offered heavily discounted promotions through Groupon. Consumers purchased those deals online, and Groupon kept a percentage of the transaction while helping merchants attract large numbers of new customers. At first, the model appeared revolutionary because Groupon promised to connect local businesses with enormous volumes of paying customers almost instantly through aggressive discount campaigns distributed at massive scale through email marketing and online platforms. The company expanded explosively across the United States and internationally as investors, merchants, and Wall Street increasingly viewed Groupon as a major technology company capable of transforming local commerce. Subscriber growth surged rapidly, merchant partnerships expanded across thousands of businesses, and Groupon's valuation eventually climbed into tens of billions of dollars during the height of investor enthusiasm surrounding the company's hypergrowth expansion. For many local businesses, Groupon initially looked like an extremely attractive opportunity because the platform promised immediate customer traffic during a period when many smaller businesses were struggling to compete for attention online. Restaurants, salons, gyms, spas, and local service providers rushed onto the platform, hoping large discount campaigns would generate long-term loyal customers beyond the initial promotion itself. Externally, Groupon's growth appeared unstoppable. The company expanded aggressively into new markets, while subscriber numbers, daily deals, and revenue growth continued accelerating at extraordinary speed. However, underneath the explosive expansion, a much more fragile economic reality was beginning to form inside the system itself. The central problem was not that Groupon lacked growth. The deeper problem was that the company's explosive growth model was beginning to weaken the long-term quality and durability of the ecosystem it depended on to survive.
Groupon's entire business model depended on a very specific assumption: that massive discount campaigns could simultaneously benefit consumers, local merchants, and Groupon itself at enormous scale. The process initially appeared extremely efficient. A local business created a heavily discounted offer through Groupon, consumers purchased the deal online, and Groupon kept a significant percentage of the transaction revenue before forwarding the remaining amount to the merchant. For consumers, the system felt highly attractive because Groupon offered extreme discounts on restaurants, travel, entertainment, salons, gyms, spas, and local experiences that often appeared far cheaper than normal retail pricing. For Groupon, the economics initially looked even more powerful because the company could scale rapidly without owning inventory, physical stores, restaurants, or most of the businesses operating underneath the platform. Instead, Groupon positioned itself as a massive customer acquisition engine, connecting local merchants with millions of potential buyers through aggressive email marketing and online deal distribution systems. At first, many businesses willingly accepted steep discounts because they believed Groupon could introduce large numbers of new customers who would eventually return later at full price. Restaurants hoped discounted diners would become loyal regular customers. Salons expected repeat appointments. Gyms anticipated long-term memberships, and local businesses increasingly viewed Groupon as a powerful traffic generation tool during a period of intense competition for online visibility. That expectation became one of the most important assumptions holding the entire Groupon ecosystem together, because if customers returned after the initial deal, businesses could potentially absorb the short-term discount losses in exchange for long-term customer value. However, Underneath the rapid growth, many merchants were beginning to discover a much more dangerous economic reality. The deeper businesses moved into Groupon promotions, the more many operators realized that large portions of Groupon customers were primarily motivated by discounts themselves rather than long-term loyalty to specific businesses. What initially looked like a scalable customer acquisition system was increasingly starting to behave like a high-volume discount engine that generated short-term traffic spikes without consistently creating durable customer relationships underneath the surface.
As Groupon expanded deeper into national and international markets, the company's growth engine started accelerating at a pace that increasingly prioritized scale, subscriber growth, and deal volume above the long-term health of the businesses operating underneath the platform. Wall Street initially rewarded that expansion aggressively because Groupon's user growth, merchant onboarding, revenue scale, and global reach appeared extraordinary compared to most internet companies at the time. The company rapidly expanded into dozens of countries, while daily deal campaigns flooded millions of consumer inboxes across restaurants, travel, entertainment, retail, beauty services, fitness businesses, and local commerce categories. Externally, the model looked unstoppable because Groupon was generating enormous transaction volume while building one of the largest consumer discount ecosystems in the world. However, underneath the growth narrative, many local businesses were beginning to experience increasingly difficult economics once Groupon campaigns actually reached operational scale. Restaurants suddenly faced huge customer surges during heavily discounted promotions, while kitchens, staffing systems, and inventory management struggled to handle large spikes in low-margin traffic. Many businesses discovered they were often losing substantial money on Groupon transactions after combining the deep customer discount with Groupon's own revenue share taken from each sale. Some operators hoped the losses would still become worthwhile if enough Groupon customers eventually returned later at full price. But for many merchants, that long-term loyalty conversion started proving far weaker than originally expected. Large numbers of Groupon users increasingly behaved like temporary bargain hunters, moving from one discounted offer to another rather than building durable relationships with individual businesses. That behavior created a dangerous structural problem because Groupon's explosive customer growth was not always generating equally durable economic value for the merchants funding the discounts underneath the system. The deeper Groupon scaled, the more the company was discovering that maximizing transaction volume was not the same thing as creating durable long-term value across the businesses sustaining the platform itself. By the time Groupon's expansion reached full scale, the company's growth engine was increasingly becoming dependent on conditions that were beginning to weaken the long-term stability of the ecosystem itself. Investors continued rewarding subscriber growth, transaction volume, market expansion, and revenue acceleration, while Groupon pushed aggressively into larger volumes of daily deals across thousands of businesses simultaneously. The deeper the platform expanded, the more Groupon's system started encouraging constant discount behavior from both merchants and consumers. For many businesses, Groupon campaigns were no longer functioning as occasional promotional experiments. They were increasingly becoming recurring traffic generation tools required to maintain customer flow and online visibility inside highly competitive local markets. That dependence created a dangerous structural trap underneath the business model, because once customers became conditioned to large discounts, many operators discovered it became increasingly difficult to return to normal pricing without losing traffic volume. Some restaurants, salons, gyms, and local businesses started repeatedly launching new Groupon promotions simply to keep customer activity flowing through the business. Over time, the platform was no longer merely introducing customers to merchants. It was increasingly training parts of the ecosystem to depend on continuous discounting behavior to sustain transaction volume. At the same time, large portions of Groupon users continued behaving more like mobile bargain hunters than stable long-term customers loyal to specific businesses or brands. That customer behavior became increasingly damaging because many businesses were sacrificing margins repeatedly without generating enough profitable repeat spending afterward to justify the discounts financially. The more Groupon optimized for transaction growth and subscriber activity, the more the platform was unintentionally weakening pricing power, customer loyalty, and long-term merchant profitability underneath the surface. Internally, Groupon still appeared highly successful because the company continued generating enormous deal volume, rapid market activity, and large-scale consumer engagement metrics. But underneath those growth numbers, the long-term quality of the ecosystem itself was becoming increasingly fragile. Businesses were carrying margin pressure, customers were becoming discount conditioned, and Groupon's growth engine was increasingly requiring more promotional intensity simply to sustain expansion momentum at the scale investors expected. What initially looked like a revolutionary local commerce platform was gradually evolving into a system where aggressive growth optimization was beginning to damage the long-term durability of the businesses supporting the platform itself. As Groupon's growth engine continued expanding, the structural weaknesses underneath the business model were now starting to directly damage Groupon's own long-term stability and market value. Many merchants that initially embraced Groupon promotions were becoming increasingly frustrated with the economics attached to the platform. Businesses often faced huge surges of low-margin traffic, while Groupon continued taking a substantial percentage of each heavily discounted transaction underneath the surface. For some restaurants, salons, gyms, and local operators, Groupon campaigns generated temporary customer spikes but failed to create enough profitable repeat business afterward to justify the financial pressure. Over time, many merchants started reducing Groupon participation, limiting promotions, or abandoning the platform entirely after concluding that discounts were weakening profitability rather than strengthening long-term customer relationships. That shift created a major problem for Groupon because the company's growth engine depended heavily on maintaining large volumes of attractive deals constantly flowing through the platform. At the same time, consumers were also becoming increasingly saturated with daily discounts after years of non-stop promotional campaigns flooding inboxes and mobile platforms. The excitement surrounding daily deals gradually weakened, while customer behavior became increasingly transactional and discount-driven underneath the system. As merchant quality weakened and customer enthusiasm slowed, Groupon's long-term growth economics started deteriorating much more visibly. The company still generated enormous transaction volume, but investors and analysts increasingly began questioning whether Groupon's explosive growth was actually creating durable long-term business value or simply accelerating short-term promotional activity at unsustainable scale. Wall Street confidence gradually weakened as concerns grew around slowing growth quality, merchant retention problems, customer fatigue, and the long-term sustainability of Groupon's underlying economics. The company's stock eventually fell dramatically from its earlier hypergrowth era highs as investor enthusiasm surrounding Groupon's original vision started collapsing. What initially looked like one of the most revolutionary internet growth stories of the early 2010s was increasingly being viewed as a business model heavily dependent on constant discounts, aggressive customer stimulation, and weakening merchant economics underneath the surface. The deeper Groupon optimized for transaction growth and expansion volume, the more the platform slowly weakened the long-term durability of the ecosystem supporting the business itself. What ultimately damaged Groupon was not the absence of growth. The deeper problem was that the company's explosive growth model increasingly prioritized scale and promotional intensity faster than it created sustainable long-term value for the merchants and customers keeping the system alive. As Groupon's long-term growth quality weakened, the company's original hypergrowth narrative started collapsing much more visibly across Wall Street and the broader technology market. What investors once viewed as one of the most revolutionary internet growth stories of the early 2010s was increasingly being reevaluated as a business heavily dependent on constant discounts, aggressive promotional activity, and fragile merchant economics underneath the surface. Growth momentum slowed, merchant enthusiasm weakened, and concerns surrounding customer retention, long-term profitability, and ecosystem durability increasingly pressured investor confidence. The deeper analysts examined Groupon's business model, the more many started questioning whether the company had actually created durable long-term commerce infrastructure or simply accelerated massive short-term transaction activity through unsustainable promotional intensity. That shift in perception became extremely damaging because Groupon's enormous valuation had originally been built around expectations of long-term dominance in local commerce and digital consumer behavior. Instead, many merchants were reducing Groupon participation, while large portions of consumers continued behaving more like temporary bargain hunters than stable, loyal customers. As confidence weakened, Groupon's stock collapsed dramatically from its earlier hypergrowth era highs, while billions of dollars in market value were erased over time from the company's peak valuation period. The company increasingly faced restructuring pressure as the original expansion model lost momentum and investor enthusiasm surrounding the business deteriorated. Over the following years, Groupon reduced operations, restructured parts of the company, and lost much of the dominant market excitement that once surrounded its explosive early growth phase. What initially looked like one of the most powerful internet growth engines of its era was now increasingly viewed as a cautionary example of expansion systems optimizing short-term growth metrics faster than long-term ecosystem durability. The company itself did not disappear completely. Groupon continued operating afterward in a reduced form across some markets and regions, including international operations, but the original hypergrowth vision that once convinced investors the company could permanently reshape local commerce had largely collapsed. The deeper problem was never simply that Groupon offered discounts. The real structural failure came from building a growth engine that increasingly depended on aggressive promotional intensity while slowly weakening merchant profitability, customer quality, pricing power, and long-term ecosystem stability underneath the surface. What ultimately damaged Groupon was not the absence of scale. The company achieved enormous scale. The deeper issue was that the same growth system driving Groupon's explosive expansion was simultaneously eroding the long-term business quality required to sustain that expansion durably over time. Groupon's rise and decline ultimately became one of the clearest examples of how explosive growth metrics can hide deeper structural weakness underneath a rapidly expanding business model. At its peak, Groupon convinced investors, merchants, and consumers that the company had discovered a revolutionary system capable of permanently transforming local commerce through scale, discounts, and aggressive digital customer acquisition. The company achieved enormous global reach. Millions of users joined the platform. Thousands of businesses participated in Groupon campaigns, and billions of dollars in market value were created during the height of investor enthusiasm surrounding the company's expansion. But the deeper Groupon optimized for transaction growth and promotional volume, the more the system gradually weakened the underlying economics supporting the platform itself. Merchants sacrificed margins. Customers became increasingly conditioned to expect discounts. Pricing power weakened, and long-term loyalty became increasingly unstable underneath the surface. The company's explosive expansion initially created the appearance of extraordinary business strength, but much of that growth depended on constantly stimulating short-term transactions faster than long-term ecosystem value was actually being created. That became the central structural weakness inside Groupon's model. The platform succeeded at generating enormous activity, but activity alone was not enough to guarantee long-term business durability once merchant profitability, customer quality, and ecosystem trust started deteriorating simultaneously. The deeper Groupon optimized for hypergrowth expansion, the more the company discovered that scaling transaction volume was fundamentally different from scaling sustainable long-term economic value across the businesses supporting the platform. Even after Groupon's original growth story weakened, the company itself continued operating in reduced form across selected markets and international regions afterward. But the original vision that once convinced investors Groupon could permanently reshape local commerce at massive scale had largely collapsed. The story was never simply about a discount company losing momentum. It was about a growth system discovering that optimizing expansion, promotional intensity, and short-term activity faster than long-term ecosystem durability could eventually weaken the very foundation supporting the business itself. Groupon did not fail because it lacked growth. The company failed because the same hyper-growth engine that created its explosive rise was simultaneously eroding the long-term value quality required to sustain that growth permanently over time.